Hello and welcome to the Gold, Goats, and Guns podcast for Monday, August 8th, 2022. Yes, I can speak words. My name is Tom Luongo, and we have a lot to talk about. Today, I have with me the great pleasure. I've been on his show a couple of times. I'm a longtime fan, an old quote-unquote turdite. Turd Ferguson, the Craig Hemke himself is in the house this morning. And I've just been meaning to have Craig on just to, in many ways, just to reciprocate the favor and just to say thanks for, years of education in an early part when I was, before I ever got into this publicly as a public figure, Craig's site and his insight and everything was a real education, circa 2008, 2009. So I really still appreciate him. And to this day, to my mind, he's still like Norm Macdonald doing Burt Reynolds, doing Turd Ferguson. So at this day, he's just still that dude to me. So Greg, good morning. Thank you for stopping by.
Wow. I appreciate the effusive praise. I'm not sure I live up to all that, but thank you. And it's a pleasure to kind of do a home and home here.
Sure.
Where I come on your side, and I know I'm going to have you back on my site in a week or two. And, and I look forward to flipping the roles and picking your brain about what's going on. But thank you again for the opportunity.
No problem. So I'm happy to pay it forward. So as opposed to what we'll probably do the next time I'm on your shows, we'll get into really heavy markets, technicals and whatnot, because that's your audience. For me, mine's more of a general geopolitical thing and looking at things from much more 40,000 foot level. So, we were chatting about beforehand and you brought up the idea that, look, we're at that point where words don't fucking matter anymore. And, right. We're in this weird space where the commies are really going for, hey, really words don't matter. We're just going to make this stuff up as we go along. And so, that's where we are. What do you think?
Yeah, there's a couple things to that. We live in this age of propaganda and message shaping, and everything's so polarized that you can get away with it, right?
Mm-hmm.
The media has their own agenda that they want to pump. I mean, just a couple of recent examples. I'm watching the nightly news last night, Sunday night, as we record this, and they're referring to the Inflation Reduction Act of $750 billion in deficit spending. And it's called why not call it the, Rainbows and Lollipops Act? I mean, you can call it anything you want, apparently, and people go for it. And then they frame it as a big win for Biden. And I'm thinking, wait a second, all he had to do was get the 50 people in his party to vote for it.
Right.
How is that a big win? A big win is when you get 80 people to vote for it in the Senate. Hey, you're really bringing people together.
Right. It's obvious that the big win was that they finally got Manchin. They finally bribed Manchin and Sinema enough to actually get them to go along with everything. So
words don't mean anything. It's like, what's a recession? I have my degree for years and years and years ago. I have a BS in economics from the great academic institution of the University of Nebraska.
Right.
But dude, I mean, I know it was 30 years ago, but still, I mean, it was 2 consecutive quarters of GDP was your definition of GDP being negative. Oh no, well, that's not it anymore. Well, wait a second. Or you get, I call them Fed goons on my site, because that's really what they are. And most of them never had a job outside the Fed. They went straight out of graduate school to work for them. And one of the worst is Loretta Mester, who runs the Cleveland Fed.
Right.
And she says last Thursday in an interview that the yield curve inverting, meaning that, it should be a forward thing where longer you go out on the curve, longer maturities, the higher the inflation is interest rates are, because you're expecting higher inflation over time. So you got to take on, you want a higher interest rate to cover that. And when that inverts, when the longer term is a lower rate than the shorter term, that is universally, and you can go back in time. I mean, we have this data. It's a precursor of recession. So Loretta Mester comes out last week and says, no, I don't think it is. Well, wait a second, Loretta, you worked at the Fed for 37 years, and in your own charts at the, that Fred charts out of St. Louis, they'll draw you a chart of how many, yield curve inversions when the 10-year yield is higher than the 2. And then the little shaded area of a recession that follows. And it happens every time.
I know. Oh, but correlation doesn't necessarily imply causality, Craig. And this is every armchair statistician who's ever, who's ever heard that phrase and then becomes a statistics expert on Twitter, because now we have stats experts on Twitter, just like we had newly minted virologist experts on Twitter during COVID, nothing. This is nothing new. I was not surprised at all. I just literally just published a blog post about 10 minutes before we hit record this morning. And I said, if you look at the way these people are allergic to saying the word recession, it's almost like they're worried about some elder god being summoned if they say it 3 times too fast.
Right.
You know, and it's just hilarious. I'm like, but maybe we do live in a Lovecraftian dystopia.
Well,
yeah, I guess we do. Maybe they shouldn't say it.
It's also, and I guess this is a pretty sweeping generalistic statement, but it's also a sign of the end of a civilization or a regime or something.
Right.
One of my favorite things I've been posting to Twitter about once a week is a quote from Alexander Solzhenitsyn. And you're old enough to remember him.
Oh, I read him.
Yeah, well, they're the Gulag Archipelago, right?
Yes, I have read.
Okay, so for anybody that doesn't know who that is, though, our Alexander Solzhenitsyn was what they used to call a dissident in the Soviet Union. The few people that were able to speak, outcry against the horrors of communism in the Soviet Empire, and were able to get away with it or get out of there, or write your book from the Gulag. Anyway, Solzhenitsyn has a quote, and I'm kind of paraphrase him. But again, this is from the end of the Soviet Empire. But he says, they lie to us. We know they lie to us. They know we know they lie to us, but yet they continue to lie to us.
Mm-hmm.
And okay, well, that's the end of that empire. And how is that not where we are now?
Oh, I think we're even one level deeper than that.
Could be.
And it's gotten to that point, I think. And when you get to that point, it's always about loss of confidence, right, in the institutions themselves, and and that's when things get ugly and chaotic. And I believe in my theory of Davos, which is that Davos is actually the oligarchs, the globalist oligarchs that are running most of this. And they run the Democratic Party, and they run the GOP establishment, and they run, so many of these people. And it's very clear that at this point, they know that their entire edifice is shaky. And so what do they have to do? Well, when things get serious, as I'm going to quote somebody else for you, I'm going to quote Jean-Claude Juncker, former head of the European Commission, says, when things get serious, you have to lie.
Yeah.
So that's where we are. And, this is straight from the Eurocommie mouth. And, I'm just at the point now where I'm done. I'm reductionist on the whole thing. They're all just commies. That's what they want. They're making no bones about it. This Inflation Reduction Act is nothing of the sorts. Funny when, they pass something like this and I get contacted by Sputnik News of all people to give commentary on what I think about all of this. I think it's just the irony of me having to, I get Olga over at Sputnik News asking me questions about this stuff. And she's like, why are they doing this? I'm like, oh, because they're vandals. They're not incompetent.
Right. And it's just because that's the phrase that's tested in their focus groups and all the other crap. Well, let's see. We are 3 months out from the midterm elections.
Yep.
All of our focus group says that inflation is the biggest worry of everybody.
Mm-hmm.
So we'll call it the Inflation Reduction Act. And a lot of people out there that aren't really paying attention or don't do the math or just don't understand. Right. We'll just simply go along. It's like if let's say that unemployment was the problem, right? And we probably are, but let's say we're clipping along at 9% unemployment instead of 9% inflation.
Right.
They'd call it the Unemployment Reduction Act.
Of course.
I mean, it's just stupid. Right. And I we could really veer off into how it's an indictment of the education system or the people that only worry about themselves, and don't want to take the time to even think about it or whatever. But it is, again, I think it's emblematic of where we are as a culture and U.S.'s place in the world. And, Tom, you've heard me say lots of times that the cognitive dissonance of the people that think tomorrow is always going to be like yesterday.
Right.
Normalcy. That's probably the biggest problem.
Yeah, it's normalcy bias.
Normalcy bias.
It's a very, very powerful thing. Yeah. Everybody, the markets always heavily discount that the cooler heads will prevail. right? I
Yeah.
mean, when we talk capital markets, like we never planned for World War III, and then World War
Right.
III happens, the markets drop by 40% because the markets always believe that, cooler heads will prevail. Hell, I got sucked into this, pre February 24th, getting sucked into the geopolitics and all of the, everybody like maneuvering around themselves and putting out narratives that I'm like, yeah, there's not going to be a war in Ukraine. Like they're just going to lay this framework out, and then everybody's going to back off and get what they want, and they're going to make the United States look bad in the process because that's their goal. And then boom, Putin's like, oh no, we're going to
Yeah.
war
Yeah.
because you guys were taking us to war anyway. And so, like,
Yeah.
it's the same thing with Pelosi's non-diplomatic visit to Taiwan,
Ugh.
which is absolutely going through the exact same steps that we saw the United States and
Yeah.
our anti-diplomatic corps. These are supposed to be our diplomats, and these people do
Yeah.
not engage in diplomacy because they
Yeah.
lie. And
Yeah.
when lying is like the first rule of breaking diplomacy,
Yeah.
diplomatic
Yeah.
rules. Like politicians are allowed to lie. Everybody knows that. In diplomatic circles, everybody knows that politicians are allowed to lie. But diplomats are not supposed to lie. They're the ones who are supposed to tell the truth and work out the stuff behind the scenes and then feed the results of the diplomacy back to the politicians who lie about
Yeah.
what we're each getting for this. But we're not even doing that. And now we're pulling this with China.
Yeah.
What does
I
that tell
hadn't,
you about where we're headed in 2023?
right. Tom, I hadn't really thought of it that way, but the parallels are almost identical.
Yes.
You go from Maidan Revolution, if you want to call it that, in 2014
Mm-hmm.
to Victoria Nuland to people like McCain and all the rest and Biden and all these people putting their kids on the board of Burisma. I mean, it was just so anyway, fast forward that 8 years to now and think about the politicians, including Pelosi, that are all of a sudden all in Taiwan.
And
I mean,
and
are we not going
and the
down?
fact that the Brits, were heavily involved in the Hong Kong stuff in 2018 against the extradition treaty, which was really about extraditing MI6 agents within Hong Kong banks back to mainland China, than it was about extraditing, Hong Kong, kids on the streets and Black Bloc. It had nothing to do with that. It had everything to do with the fact that like Standard Chartered and HSBC and the rest of them they are all stabbed by MI6 like up and down the line. Let's not kid ourselves, like, right?
Yeah.
And all the money laundering and the drug money laundering and all the rest of it that was going on, the destabilization stuff that was happening, and the intelligence passing that was happening through the Hong Kong banking system. So, and that's why they were like, no, we can't have this extradition treaty.
This isn't coming to light.
Yeah, we can't have this. So, and then obviously now 4 years later, now we're dealing with these are attacks on China, but just even the lack of willingness to engage in any kind of real diplomacy is just laying out the last 3 months. It's from the time that I think from like November of last year until February, it was very clear that the Americans were not listening and they were trying to just piss the Russians off to the point where they would go to war.
Yeah.
And now we're doing the same thing with the Chinese, and that puts the timeline somewhere around January.
And for people listening to us, and I know you address this on your site, but the financial implications of all this to your IRA, your 401k, your portfolio, your hopes of retiring, all that stuff are enormous. Yes. And your stockbroker, your financial planner down the street probably isn't talking about this stuff or taking it into consideration. Just one,
not at all,
base level. The world has existed, as with a dollar as the central currency for 80 years. And because there's no competitor to it, that creates a false level of demand for it, which is why we can create 30 trillion of them going into debt and not have, this massive inflation that we're only seeing the tip of, because all those dollars get printed and shipped overseas as we buy stuff and the like. And then those countries that end up with dollars in reserves buy our treasury bonds, and the whole thing kind of stays quarantined. But if we go around pissing all these people off, which we have, eventually they're going to say, well, fondue, we're not messing with your system anymore. And then they create some type of competition. It doesn't have to, whatever currency doesn't have to, usurp or supplant the dollar. Right. It just needs to chip away at that demand. And now, like anybody knows, everybody's heard of supply and demand, and if you increase the supply of something, while decreasing the demand, the value falls.
Right.
And that's simple. I mean, that's just econ 101. And so as you extrapolate that forward, the impacts of all this geopolitical stuff, what that ultimately does to your currency, what it does to your standard of living, what it does to, where you think, what you think your standard of living is going to be 20 years from now. These are all really dramatic things. And you can't just run up put the Ukraine flag on your Twitter account because, I'm a patriot and I'm for everybody that's a freedom fighter, without thinking through, you're not only the geopolitical implications, but your own implications.
Yes.
And nobody does that, or very few people do it. And that's what, again, that's, you heap praise on what I do, man. I tell you, I'm so glad that what you do continues to grow and your platform gets larger, because you do a great job of explaining this to people. And the more people we can warn,
that's
and
all
help
we can
them
do.
Prepare, that's all we can do.
I know. So when I think about this, right, and obviously, you and I are both gold guys, and we're both hard money guys, to a greater or lesser extent. I'm also a Bitcoin guy as well, but
me too.
The point being is that, gold is not the only answer to this equation, but it is one of the important answers to this equation. We have I think you might want to speak to this, because I mean, this is the weird part about this, is that I almost feel like, and I hate to remind people, but I feel dirty every time I have to say, I think the Fed's actually doing our job for us, actually helping us at this point, as opposed to hindering us. At some point in the future, they're going to turn right back into the Fed of old and predate us. But right now, they have bigger predators to deal with that they're fending off. And I think of the same way about our commercial banking system, as flawed and as vile and as corrupt as it is. I'd rather have that than a bunch of Eurotrash commie Malthusians who just want to kill everybody. Right. I mean, this is your Hobson's choice in the world, right? I'm not advocating this. This is far away from where I want the world to be. So one of the things that I think we can really talk about here is, I was listening to a podcast with a variety of people, including Jim Rickards, and they were talking about how gold is underperformed. And actually, Jim brought up the point. I think it's a salient one, and I'll turn it back over to you in a second now, which is that actually gold, in the strength of massive dollar strength, has actually performed better than anybody should have ever expected it to.
I suppose, yeah.
And as bad as it is, we are talking about the what's gold down, 3% on the year versus, it's up 9% versus the euro, or 9-10% versus the euro, about 15% versus the yen, right? Yeah. So, we had a nice bounce off of, because we as gold guys get really impatient with all the shenanigans and all the narratives and all the time and all the way they manipulate our perceptions of things. We have to remember that gold is going to do what it's going to do on its own time once the confidence in the system starts to collapse. Yeah. And I think we're in that next phase where confidence is going to start collapsing. And I really do think we're probably set up nicely now for the next leg of the gold bull market.
Well, Tom, now you've opened Pandora's box. If you need to go and use a restroom or something, now's the time, because I'm about to talk. I could
go for it, man. I'm done talking.
I'm good for the next half hour, 45 minutes now. Let me go back to one part of what you just said about gold and relative performance, and the people that are out there so happy to say, oh, it's not an inflation hedge. See, 9% inflation and gold's not. Okay.
Shut up, Martin Armstrong.
I'll try to put this as concisely as I can. And again, I don't know how else to back this up with any kind of gravitas or something other than to point out that this has been the sole focus of my life for the last dozen years.
Sure.
Gold is not priced through the exchange of my gold for your dollars,
right,
or your pounds or your yen.
Yes.
Gold is priced through the trading of derivative contracts, forward contracts in London, futures contracts in New York. It should be that the actual physical market then wags is the dog and the tail is the futures market. This is the other way around.
Right. Okay. Absolutely. Agreed.
And that's what's going on. When people should be paying attention to this trial in Chicago of the former head of JP Morgan on trial and RICO charges for manipulating price.
Sure.
In the current world, and again, I'll try to keep this as concise as possible, everything is traded by computer.
Yes.
If you're listening to us, go look up your daily volume on the New York Stock Exchange and look at the volume that it was 20 or 30 years ago. And it's 10, 20 times higher. You see the volume of shares traded. And it's not because I'm calling up Tom Luongo and saying, hey, Tom, let's buy 200 shares of Walmart.
Right.
Okay. It's all these computers that are built. They actually build these high frequency trading computers in places where the hubs are, the server hubs are, so that they can act just in that 1,000th of a second faster to screw somebody else's high frequency trading computer. Okay, so 85, 90% of NASDAQ volume every day is these high frequency trading computers flipping positions back and forth. Well, hell's bells. I haven't seen a study as to how much volume it is on, COMEX gold or COMEX silver is high frequency trading, but I can assure you from watching it, and watching the tick for tick, the dollar just ticked up 5 cents and gold went down $2. I can assure you humans don't act that fast.
No.
Right? Nobody's dumping their physical gold. They're trading these futures contracts.
Absolutely.
So now, again, I'm sorry if I'm waxing.
No, you're doing great. Go for it.
All right. So here then, so then what prompts not only the supply, we can worry about the supply of the contracts later, the demand for the contracts, who's buying them? Well, hedge funds and these machines, right? Well, and the machines are programmed by humans. These algorithms are written in. And so since these are kind of secondary things, and silver might even be a tertiary thing in someone's portfolio of, whatever, at a hedge fund, they write them in to take their trading cues. These computers will take their trading cues off of other markets.
Yes.
Like I said, the dollar goes up 10 cents, gold goes down $3, that sort of thing immediately.
Right.
Okay. Well, the other thing, probably the biggest long-term driver in this current situation is real interest rates.
Agreed.
Okay. It's not just the stated level of inflation. Oh, it's 9%. No. It's real interest rates. It's what are you getting on your 10-year treasury note when you adjust it for inflation? And now here's where it gets even more screwed up, Tom. You and I, as logical carbon-based people, can look at that and go, now wait a second. Okay, the 10-year yield on the 10-year treasury is 2.6%?
2.8, I think, this morning. But yeah.
What was inflation, CPI inflation at last guess? 8.8%?
9.1, something like that. Yeah.
Whatever.
Yeah.
And you can go, that's minus 6%.
Yep.
So if I'm losing 6% of my purchasing power this year, and probably at least another 3 or 4% next year, how much positive? How far does inflation have to go negative for me to at least break even by the end of the 10 years?
Right.
That's how human beings think, right?
Right.
But that's not how these computers are programmed. Instead, there's a market for inflation expectations. People go, what? Yeah. But there's a market for freaking everything.
Yes, there is.
But they call them break evens, 5-year break evens, 10-year break evens. And those are your inflation expectations, your official ones, the ones that the computers that trade the precious metals base their real interest rate forecast off of. So you get the 10-year treasury note at 2.8%. You get 10-year inflation expectations at 2.8%. And the real number that these computers base their buy-sell decisions off of is a 0% real interest rate.
I know.
When it's actually -6.
That's right. Yep.
And so to put all this back together, when people say, well, gold hasn't responded. Well, that's why.
Right.
Because no one's trading actual gold. It's just the computers trading these digital derivatives back and forth, and they're making decisions based off of phony baloney data.
Yes. Yeah.
A false indicator. So anyway, I'm sorry to.
This is really important because I touch on these ideas directly in a lot of writing and whatnot, but it's better to have somebody who understands the guts of the trading, because I don't trade gold futures. Like I never have and I never will.
And you shouldn't.
No, absolutely. And people ask me, how do I trade gold? I said, don't trade Microsoft. It's easier. Just trade Microsoft. It's easier. It's not politicized.
Right. And
pick some stock that no one cares about, that no one's trading, that no one's making a market in derivatives on, and trade that.
Have fun with that.
And learn how to trade those, because those signals make sense. But gold, Bitcoin, silver, these are the most politicized markets on the planet, and therefore they're impossible to trade.
And they're criminal, and they're run by criminals.
Of course.
That's why I talk about these JP Morgan guys that are charged under the RICO Act.
I know.
Like mafia.
I know.
Okay. So anyway, the moral of the story is because of the way these things are priced. It's like rent control in New York.
Yep.
You drive this divergence between what the price is and versus what reality is.
Great.
So really all we can do as mortal human beings is educate ourselves and understand how totally fucked up all this is. And then look at it and go, okay, wait a second. I don't think $1,800 is a fair price given, the amount of debt there is in the world. I don't think that's accurate. And you mentioned it being a confidence scheme. The gold market's a confidence scheme because nobody ever takes delivery. You got all these unallocated accounts and ETFs and all this other bullshit that's used as people to get exposure to the digital derivative price. And it's all crap. It's all garbage. The only thing that's real is that ounce of gold that you take delivery of and hold in your own two hands.
That's right.
That's real. And as the whole thing kind of finally starts, Solzhenitsyn's empire of lies finally starts to fall in on itself, you gotta own something that is real and tangible and that you know what it is.
Great. Agreed.
And that's what gold is.
Yeah. And so I'm going to just now listening to all this, and it's great. And it's brilliant. And thank you very much for this, because I think it's important that people understand, like, this is the world that traders like yourself, go through and live in, and they understand, and you understand the plumbing of this. Part of the reason why I wanted to have you on. I knew we would get it. I knew if I triggered you enough, I'd get you to talk about this stuff. And then therefore I wouldn't have to expose my own limited understanding of the guts of this. I understand it from a more high level position. So now I'm going to take us back to last year when I was first on your podcast. And it was my article about Basel III and gold.
Yeah.
Right?
Yeah.
So now think about where we are, and I'm going to throw this at you. And you're probably going to be stuck with the current definition of mixed emotions, which is the following. I see the JP Morgan gold trading lawsuit as revenge by Davos, who needs a higher gold price to support the ECB's deteriorating balance sheet. And the implementation now of some of Basel III to separate out gold derivative exposure versus normal derivative exposure, where it was stuck in Forex previously. Now it's been separated out, and everybody's asking me, what does this mean? I'm like, well, they changed the definition of these things. That's all it means. They went from Forex, with general Forex derivative exposure, to now specifically gold exposure. And it's part of the process of trying to educate people that Europe needs a higher gold prices to bail out a sinking ECB, while the Fed, in order to maintain confidence, still needs a low gold price to maintain confidence in the dollar. So to me, I see this as purely, this is one of those things where, okay, we're in a rock and a hard place. Like, I think the Fed is horrible and vile and doesn't need to exist. I don't believe that the gold futures market is any way, manner, shape, or form a fair or even honest market. In no way, manner, shape, or form is any of what I've ever said over the last year an endorsement of this system, except for the fact that, given the fact that the system is so screwed up, and there are a bunch of people who are actually trying to tear that system down but replace it with something 10 times worse, which is 100% tax compliance and surveillance under a central bank digital currency system with no ability to assess risk through the capital markets, because that's what they want to do away with. So that's by doing away with commercial banking. We're talking about doing away with the concept of risk assessment by the marketplace. We have to swallow the pill that first we have to break them before we can break JP Morgan.
No, I know. What can I argue with in that? And I think you were dead on. And I remember when we talked about that last summer, because the ECB has no assets.
No.
And they had nothing else they have on their balance sheet. If rates spike, as you've always said, and all that 9 trillion euros in bonds goes down, they become insolvent. And the only asset that they have is their however many tons of gold
that the member central banks have pledged as collateral. But they're not under any obligation to actually deliver.
They could make a run on them too.
I mean, and
I hear you, brother.
And if you think the Italians, after Giorgia Meloni and the brothers of Italy take power in 6 weeks, are going to pledge their 3,300 tons of gold, of sovereign Italian gold, to the ECB, I got news for you. Mario Draghi's not on the scene anymore. It's Christine Lagarde, and she doesn't carry the same weight.
Every man for himself. And the old "who has the gold makes the rules," and in a confident scheme like the way it's currently run. If you're not the first person in line to get your gold out, you ain't going to. It's like if you've got one of these unallocated accounts at one of these banks or bullion dealers around the world, and they tell you, hey, no, your gold's there. If you ever want it, just come up, give us 60 days and we'll get it to you. Well, if everybody, it's just a classic bank run. Everybody shows up at the same time because they've lost confidence in the bank or the scheme. The only person getting their cash out is the person that gets it while they're still cash in the vault.
Right.
So
Because
it's the
fractional reserve
same old
banking is
confidence
designed around the
scheme.
idea that there's 10 claims of property to the same piece of property. That
Right.
there's 10
Exactly.
ounces of gold worth of claims versus the every ounce of gold. And it's the same.
Precisely.
And we have
And
what, 200 plus? What's the current number for the gold market in terms of
who
gold
knows?
derivative ounces?
Yeah, no one. Yes. It's like when people say, "Well, what's the right price? How much? What should gold be worth?" I've for 12 years. I said, I got no fucking idea. How would I know? Tell
Exactly.
me how many ounces there are.
Yeah.
You tell me how many ounces there actually are. Clear title, provenance, and all that stuff. Okay, right. We could probably come up with, we got a metric, we've got a numerator and a denominator, and we can come up with price per ounce.
Right.
But I don't know how many ounces there are. How many times has every ounce been hypothecated, rehypothecated, loaned and levered and forwarded and all this other crap?
Right.
So I just know it's not. It ain't it's not $1,800 per ounce. I know that.
And I know they don't ever want to see it go to $18,000 an ounce, but there's going to come a point, Craig. I think this is going to be the very interesting part about this. The last little point I'm going to let you throw. I'm going to throw this at you and let you think about it, and then I'll let you go, which is the following, because we're right about 30 minutes. Thinking about how the United States gets out of its current fiscal problem, which is that we have to stop the Democrats and Davos from spending us into debt, which, we lost the battle this week with the new mini-me version of Build Back Better and the inflation reduction.
Right.
All right. But we won a lot of battles last year, right? We didn't get Build Back Better. We got a vastly reduced infrastructure bill. The debt ceiling was not really pushed. A lot of good things happened. So now on a forward basis, we've got a lot lower projection than what the market was discounting even 18 months ago when Biden took office. So let's put our hats on a few years into the future and let's think about the scenario, which is that if we do get that, we get fiscal under control and we get some Republicans or at least some MAGA types come in and say, okay, we're going to run the Reagan Volcker scenario. And yes, we're going to go through a horrible recession because the yield curve is telling us this. And there's no way of getting around it. We can't stop it. All we can do is embrace it and try and move out the other side of it. How do you balance the Americans' balance sheet? How do you balance the books and keep the maturity, the U.S. Treasury debt from maturing out and forcing fiscal default? You roll it all out in 50 to 100-year bonds back to 5 to 10% in gold, which was Mnuchin and Trump's plan, which they didn't actually fully tell us back in 2018. Judy Shelton let that little bon mot out the door. I don't know if you heard that or not.
Okay. No, I never heard that before.
Yeah, no, she was talking about this with Grant Williams on a podcast a couple months ago, which was, again, it's one of those moments in life where you're like, okay, that's a touchstone. I'm like there are certain things that have happened, and that one is that. Which imagine the Fed then needing a higher gold price.
Yeah.
In order to be able to balance the fiscal books of the United States. Yeah. And that's the plan to get out of this. Because I can see that path.
Well, it's like the kind of dim-witted people out there that say, well, there's not enough gold to go back to that. Well, there's plenty of friggin' gold. You just got to price it higher.
Well, and there's plenty of gold. And if gold wasn't trading at $1,800 an ounce, $20 over its average all-in sustaining cash cost of every miner, there'd be plenty of gold hitting the market.
There's plenty of gold at $30,000 an ounce. It's just
there's plenty of gold at $2,500.
The right price. Yeah. But I think the other thing, Tom, about the Volcker days and all that kind of stuff. The first thing that comes to mind, remember I think it was a one-time deal. Jesse Jackson hosted Saturday Night Live about 40 years ago. And there's a skit called The Question is Moot.
Yeah.
And
I remember that skit. Dude.
Yeah. And somebody'd ask him something and everything would be, the question is moot. And then he would go on to say why, and it was great. My brother actually met Jesse Jackson at the airport like a year ago. Right. He said he's the nicest fucking friggin' guy he's ever. You think of Jesse Jackson as, a race hustler or whatever, but he's had quite the life. Anyway, I digress. Yeah. I think that Volcker, raising, the question is moot because if anything, because of the law of exponential. Rates of return.
FYI, when I say a Volcker moment here in the United States, I'm talking 6% on that. I'm talking 6% on the Fed funds rate. I'm not even talking 12 or 13 or 14.
Dude, they can't even do that, man. Just because the numbers are so large.
Yeah, but
20% on $1 trillion is 200 billion, right?
but so much of that,
6% on
yeah, so much,
6% on 30 trillion is 1.8 trillion.
but most of that's already issued at near zero coupons. It's not it's the new debt. So if you get the fiscal stuff under control, they're not issuing new debt under that level. Now the tips and all the other stuff that you're going to have to pay that stuff out at that rate, certainly, but there's other ones that are variable rate, but for the most part, it's fixed rate debt. It's at a low rate.
But Tom,
I'm more worried about the average maturity of the yield. It's only 5
which is what? Is it 3 years now?
What's that?
I mean, the average maturity.
I think it's 5. I think it's just under 5 years.
I thought it was whatever. Maybe you can spike rates before you got to refund all that debt.
I just don't think it's gonna. I just think it needs to bankrupt the ECB in the next 18 months, and then after that they can bring everything down. I just think the euro dollar markets are pricing in a pivot in January, and I think they're wrong. I don't think we're going to get a pivot until June.
Could be. I don't know. Again, this is a fun discussion.
Sure.
Ponder, and you're such a brilliant mind that you can roll this around in your head, and I think it's fun to talk about.
Sure.
But I instead see it as I like to say there's a fine line between being cynical and being realistic, right?
Fair.
And I don't know which side I'm on in this case. Mm-hmm. But I think the politicians in their own cynical worldview just do whatever they can to keep the plate spinning another day, another week, to keep their power, to keep the money train going so that they can amass as much money as they can before they leave office, that sort of thing. And I think the bankers are the same way. I mean, why would people have asked me in the last couple of months, why does Powell sign up for a second term? I had no friggin' idea. Who would want that job?
Danielle DiMartino Booth kept asking that question. And I remember her asking that question, and my response to that is, he's there, and he has a reason. So as much as you look at it and you say, okay, it's like Biden and company, antagonizing the Chinese. Well, that's dumb. What did they get out of that? Why did they send Pelosi to Taiwan? Maybe the goal wasn't what you think it is. They're not acting in our best interest, and therefore you have to reframe the question and say, what is their purpose for doing that? Not that they got nothing for it, that they're incompetent, but that they have a different agenda. And maybe Powell's at the Fed because he sees this, because, at the end of the day, he's a guy that understands and he's got enough people around him to understand that, look, we don't want to destroy capital formation for the next century.
Right. Or as I cross the line over to cynicism, he's just a megalomaniac who thinks he can fix everything because he's the smartest guy in the room because everybody tells him he is.
Fair enough.
I don't know. I don't get that
vibe off of Powell when I listen to him talk. Like Lagarde, I get that vibe.
He seems like a nice guy.
Yeah. I get that vibe off of someone like Lagarde. I certainly get that off of Draghi. I got that out of Bernanke, right? But I never got that vibe off of Powell.
He seems like he does. I agree with you completely. He doesn't give off that vibe. But let me go just one last example I've used a few times recently. I think of that moment in March 2009 was kind of the salient point in our financial history.
Of course,
when Ben Bernanke came out and said, "No, we're going to do $600 billion in QE, and it's a one-off, and it's not really monetizing the debt that we're buying treasuries." And again, words don't mean anything, right? Yep.
Agreed.
So, all right, what has happened since? Well, it wasn't a one-off, obviously, and then QE2 was about $650 billion, and QE3 was $1.1 trillion. This most recent thing was what, 4 or 5 trillion?
All because of the CARES Act.
And so think of, again, that's that exponential thing I'm talking about,
no, I agree.
Right? Like your credit card debt. And so the metaphor, and I don't know if it's a good one or not, but I'll use it again. The metaphor I use is like the chick watching the guy go off to war in the train, and she's standing there talking to him and he's in the window and she's, and then the train starts pulling out and she's jogging along with it. And as it's going faster and faster, she has to run faster and faster. And if she slows down, or God forbid stops while the train is accelerating, she's got to run her ass off to catch up. And eventually the train's going so fast you can't catch up. And that's kind of what QE is. They did 1 and 2 and 3, and then they spent like 5 years telling us how they were going back to normal rates, which they never did, and how they were going to taking the balance sheet back to 1 trillion, which they work off 700 billion in 5 years. And then finally the market broke. So now they're playing the same bullshit again after 5 trillion. Now they're saying, oh, we're going to go back to 7. No, they won't, but they've stopped while the train keeps chugging, which means they're going to have to run even faster next time. So your next QE on whatever crisis it leads to it, whether it's economic collapse or whatever, is going to be like $8 trillion, because they're just going to try to keep the plates going as fast as they, for as long as possible. So that's kind of where I fall in all this.
I understand that, and it's always been my base case scenario. And I'm not saying that you're in any way are you wrong about that, but that is under the rubric of a Fed working as the central bank for the world. And I don't believe we have that rubric anymore.
And they may not, and that's right. We may.
And if that's the thing that's changed, then a lot of our assumptions about where the Fed is and is not capable of going. And I think that's the thing that every hard money guy should really be asking themselves.
Yeah.
Because what I see is the Fed saying no. And we finally have a Fed chairman after Yellen and Bernanke, who were both globalists and both academic eggheads who never worked a day in their life, never worked in private equity, never originated a loan, never underwrote anything, never did any of that stuff, never invested their own money, never did a thing. And then you got a guy like Powell, who comes from a private equity background, who knows guys with the stiff collars and the striped shirts, who have their kids in the Hamptons, the whole nine. He understands that world far better than Bernanke and Yellen ever did.
Yeah.
To me, it just feels like he's going to take if they're getting screwed, then he's going to have their back. And he may break everything in the process. I mean, don't get me wrong.
Yeah.
He may break everything in the process, but at the very least, he may pave the way by breaking it for something possibly better, and certainly better than what Klaus Schwab has for us, which is bugs and living in cubicles and
I certainly understand your point of view, and I really maybe you can link, Tom, in this podcast page, that article that you wrote from June or July of almost exactly a year ago about how the ECB needed a higher gold price.
Yeah, it's from March actually, but
okay, because I think people should read that so they give it their full consideration.
Sure.
I just I'll throw one more thing on there though. I mean, what if Powell is intent on this, and this really, and it could be, you could be dead right, but there are other actors in the deal who might disagree with that approach, that all of a sudden, oh, Jerry, you're being a little stout with things. Maybe we ought to dig up some of this in your background and figure out that you need to go. And we're going to go ahead and once you're out of the picture, we'll put Lael Brainerd in charge and she'll play ball.
We tried that last year when they tried to get him on the. They got their. They went their. They took their shot at the king and they missed.
Well, maybe
they got
Kaplan.
They got Rosengren. They got Carita. They dragged out his confirmation for 6 months.
Maybe they'll come. You never know. But anyway, at the end of the day, let's put it this way. I feel pretty good about still having an allocation to physical metal regardless of the outcome.
Absolutely. There's no other way around it.
And they could pump the dollar and all that kind of stuff. But, you mentioned confidence, and that's the key to everything, right? The only reason I transact with you in dollars is because, if you want to buy something from me, why would I take, $5-6 for a bushel of corn that I grew if I don't have any value in confidence in the value of that dollar? If I think it's going to take 7 or 8 or 9 tomorrow, that Weimar Germany health. Jeez, oh my God. This freaking book right here on my desk.
When money dies. Yep. That's right.
Yeah. And the parallels to exactly 100 years ago, 1922, are remarkable. But when people lose confidence in that purchasing power, the store of value of the dollar, the only way you get it back, I mean, this is what happened at World War II that made the dollar reserve currency in the first place, is you back it with something.
That's right.
And we've been fully unbacked now for 50 years. And that confidence, that pendulum has just been swinging farther and farther and farther to losing confidence to the point where it gets to nothing. Everything is crisis, is conflagration. And then what do? To establish confidence, you got to swing the pendulum all the way back over and start over.
That's right.
And that eventually is where this is headed. And that's why, again, you've got to own some physical
Yeah, I
gold
mean,
and silver or
you
something,
pick your allocation number
whatever it
that you
is,
like.
Bitcoin,
Whatever your,
whatever.
5%, 15, 20, 30, 50, I don't know, whatever.
Yeah,
You pick something
whatever.
that you pick it, but you have to. This is, and but at the same time, I don't, I always say the same thing, which is that you're going to be patient with this, like everything else, because gold is going to act. There's so many foreign actors, as you pointed out so nicely earlier in the podcast. There are so many people acting on gold because they're all of their bailiwicks, all of
Yeah.
their lives
Yeah.
are dependent upon keeping the price of gold under control.
Yeah.
So they're gonna keep the beach ball underwater for as long as they can, and then it's
As
going to
long as they
explode to
can.
the upside.
And what you need to do, not you, but everybody listening to
Yeah,
us,
royal you. Yeah.
is educate yourself on the dynamics of all this. And I bitch and moan a lot, really multiple times a day about the dynamics, let's just call it that, of how
Right.
the pricing scheme works.
Mm-hmm.
But at the end of the day, it's a sale. I mean, I recognize what the true supply demand is, and I look at that price at $20 silver and go, I think when this all sorts itself out, I think 20 is a pretty good price for that stuff.
I
And
agree.
the one more thing I would add about that, nobody has any patience for anything anymore either. Now I know silver's been doing this shit now for a decade,
Right.
but if by 10 more years from now or 5 years from now or whatever, this all sorts itself out, that decade will have been worth, but nobody wants to look at. It's like when I was a stockbroker, dude, if this is 1991, if I could, like I mentioned, selling you 200 shares of Walmart, if I could sell you, a utility stock, your local utility, and it went up 5% a year and you got a 5% dividend, you made 10%, you were like, I'm doing my job.
Right.
If you don't make 10% by Tuesday, it's like within this
You're going
stupid
to talk about
inflation,
hyper Bitcoinization
right?
of
Hyper
markets.
financialization.
Yeah, exactly.
It's like this stupid inflation reduction thing. Built into there is some incredibly positive fundamental news for uranium and nuclear energy.
Great.
And the dynamics of that are undeniably bullish.
Yep.
And I can buy any one of a handful of uranium stocks or whatever and feel pretty good that in the next 5 years, they're going to double.
Yep.
14% a year or whatever the hell that works out to be.
Yep.
Who cares?
Right.
I got to have that double by the end of next week, or it's a piece of trash that I never should. What happened to that? I mean, double's pretty good. So anyway,
doubling your money in 5 years in any market is a good thing.
Right. So with that in mind, again, understand what gold and silver are, understand the role they play, the role they've always played as money going back for millennia, and just make sure you own some, because I think regardless of the pathway, the flow chart to get from here down to here, we're going down there at some point.
Yeah, well, we're getting there. And
you're
the fun part's going to be how we get there, and then what the final number is going to be. The flow chart's going to determine what the final number is. Like when we decide to balance the books, is it going to be $7,000 gold, or is it going to be $70,000 gold? Right. But it's going to be 7 at a minimum, and then we're going to figure out from there. That's the way I look at it.
I'm laughing because you said it's the fun part.
Well, it is from my perspective. All I get to do is comment on it. Like I have my gold. I have it, and when I want to buy more, I just go and buy more. And then I put it, I wait for a dip because I can read a chart, and then I buy more. And then I go, thank you. And then we move on. So
it's been so much fun, Tom. Look at
absolutely.
your hair.
So
Craig, that's how much fun it is. Look at mine. Yeah, look at this.
And yeah, for very small values of fun. Let's put it that way. All right. I think we'll leave it there.
All right. Hey, we'll continue these topics whatever, late next week or the following, whenever that is, when we visit on my site. We conclude this Home and Home series.
Absolutely. Appreciate it, Craig. You take care now and have a great day.
Hey, Tom, it's a pleasure. We'll make sure we do it again soon.
Absolutely. Bye-bye. Well, that'll about wrap it up for episode 116 of the Gold Goats and Guns podcast. If you like what you heard today, give a like, give a subscribe, do the thing. You guys know how that works. You can follow my work, as always, on my blog over at tomluongo.me. You can follow me on Twitter at TFL1728. And, of course, you can sign up for the Patreon over at patreon.com/goldgoatsandguns, where you can sign up for either just the biweekly market reports and private blogs, or you can get also the monthly investment newsletter with 100% original material and a bespoke portfolio designed to help you try and make sense of a world going, well, rapidly mad. So you guys be well. You take care. We'll talk soon. Keep your stick on the ice.